Banking Group has announced its full-year results for 2025, enjoying £6.7 billion in pre-tax profits. That's a 12% increase on the previous year, while the group's total income also rose by 8% to revenues just shy of £20 billion. We can speak now to the bank's Chief Executive, Charlie Nunn. A very good morning, Charlie. Thanks so much for joining us.
Morning, Will.
Off the back of these results, your share price is at a 12-month high. You've more than doubled over 2 years. What's the headline thing that's gone right over these full-year results?
Yeah, so another set of strong results in 2025. I think the most pleasing thing is the growth that we wanted in the business has come through. Customers trusting us with more of their savings, deposits, their borrowing, and obviously activity around our other operating income. You said it, we saw another 9% growth in other operating income and 6% growth in net interest income. So really grounded in the investments and the innovation we're doing and customers trusting us with more of their business.
I'm interested on your outlook for interest rates this year. We've been on a rate cutting sort of cycle here, despite inflation still being well above target. What are the trade-offs from here for you as you weigh this up for the economy as a whole? Is the economy very interest rate sensitive, such that cuts will be a benefit, or does the central bank need to start thinking a bit more about inflation and the cost of living?
So look, our forecast for 2026 is what I'd characterise as a very resilient but slower growth economy. We're predicting about 1.2% GDP growth this year. We've got 2 rate cuts, 2 more base rate cuts planned that we expect happen in 2026. And unemployment, we think, will peak in the second quarter and then start to slowly come down, but stay at the levels it's been. So a very resilient economy. Underlying that, though, there's quite a different story. When you look at households and businesses across the UK, although some sectors and some households are struggling to make ends meet, the majority have improved their financial resilience. Actually, 60% of households improved their savings and reduced their indebtedness last year. So households and businesses are actually very financially resilient, and there is the opportunity to move to a higher growth trajectory. We just need to reinstill that confidence in customers and get businesses, especially SMEs, investing again for the future. And we're very focused on that as Lloyds Banking Group. Actually, we want to do at least £35 billion worth of lending this year to corporates and SMEs across the UK, and obviously continue to support all of our retail customers in the way we have over the last few years.
A lot of people kind of wonder today what the USP is of the UK for the next decade going forward. It's an interesting moment in time where suddenly, this start of the year in particular, but last year too, people are questioning the independence of the US Federal Reserve, the central bank in the US, and it's led to crazy moves in the US dollar in the last few days. I wonder what your take is on that, and whether there's a sort of little bit of an opportunity there for the UK.
Yes, I mean, as you'd know, I have a very optimistic outlook for the UK. We haven't yet really seen the difference for that for households and businesses. GDP growth has been slow for the last few years. But when we look to the future, we do think the UK has positions of strength, strong underlying financial resilience of households and businesses, some very important sectors that are leading in the world, not just financial services, but also advanced manufacturing, biotech. You've heard these being talked about by other people on this show, which is really important. And when you look at investors' confidence in the UK, it remains very, very high. I obviously just came back from Davos last week, and we've seen investors, even those in the US, looking to rotate out of the US last year. And we think that will continue over the next couple of years as investors look to diversify. And the UK is a really strong destination for that investment. And then on top of that, we now have a set of changes coming into effect this year through government policy around some of the big infrastructure investment, the reforms in planning, some of the co-investment or blended finance around things like housing and housing benefits that we think really provide an attractive opportunity for the UK and for investors in the UK. So we're fully behind all of those things. It's been what's supporting our growth. Despite that, as I said, at the moment, we're still projecting a relatively slower growth economy in 2026. And our view is this has to be the breakout year where we really come together between finance, industry, government to make this the place that people want to invest in going forward.
On the topic of investment, another sort of measure the Chancellor's been focused on was trying to encourage people to be a bit more engaged in investing their savings. Have you seen any pickup in that, and what sort of age groups?
So it's early days as to whether there's been a pivot back into the UK overall. We are seeing pick up from younger people investing. We have a product called Ready-Made Investments and Ready-Made Pensions, and we've seen 40% of those are being opened up by the under 35. So lots of engagement around this. The good news is, we manage a lot of pensions money for people in the UK. We've got the second biggest workplace pensions business. Already, of the 200-ish billion we invest on behalf of our customers, 21% of that is invested in the UK. And we think there's opportunity for customers to take even more of that to the UK as we build out new products for them to access the UK. So it's actually already a big part of our business, supporting our customers and their pensions to invest in the UK. But we think there's opportunity going forward as these policy changes come into effect this year and as we go forward.
On the flip side, obviously the budget did see taxes go up again in order to fund more spending. Is there a message from Lloyds or from the city more broadly about whether there's room for further tax increases in the year or two ahead? Without kind of going into all the line items, is the tax burden high enough as it is?
Look, I mean, tax will always remain a decision for the government. I think what you saw from the markets, and including obviously financial services, was the budget last November did give stability. There's a buffer in there that gives the markets confidence that we can navigate this next few years. And as I said, our focus in that context now is how do we support households and businesses to kind of use that financial power that they have got to build that confidence to continue to be first-time buyers, continue to spend, continue to hire people, and then invest in productivity and growth. And this AI opportunity we have as a country to use the new AI tools to drive our differentiation and productivity over the next few years, we do think is a significant opportunity for business as we go forward.